morning everyone. Welcome to the FY25 results for the MTEC Group. So these are results through to 31st of May 2025. So you've got myself and Neil Elton, our CFO, with you this morning. Looking forward to kind of taking you through the progress we've made in FY25 and kind of sharing kind of some of the thoughts on kind of what the rest of FY26 looks like. In terms of kind of plan for today, we're going to run through some of the highlights, so talk through those at a kind of fairly high level. Neil's then going to take you through the financial results in some detail, kind of talk through how they've looked. I'm then going to take you through some of the operational updates and the outlook for FY26, and then we'll move on to Q&A and kind of any questions that anybody has. So yeah, if we jump forward to the highlights, I think FY25 was a very strong year of delivery for the business. That delivery was done in the backdrop of quite a challenging environment. A lot of political change, lengthy spending review process, and kind of really pleased that we've been able to kind of grow at pace and achieve sort of these set of excellent results within the context of that quite difficult backdrop and market. So really pleased with how we've got on in FY25. Revenue grew to 46.4 million, up 20%. So another kind of strong year of top line progress. Adjusted EBITDA up 47% to 3.5 million, a margin of 7.5%. Generating free cash flow, which was something we talked about kind of previously and now starting to come through nicely. A net cash position increasing by 36% to 10.4 million. So that's 2 years of kind of profitability improvement, margin improvement, and cash generation. So really helping to underline kind of the progress we're making in building a business that's sustainable, profitable, and got the right foundations for moving forwards. On the sort of sales performance, I think that was even stronger. Bookings reached 82.1 million, which was a 128% increase on the prior year. That brought our contracted backlog up by 52% to just over 92 million. And really importantly, a lot of this growth came from existing customers, right? So signing new contracts with existing customers and a kind of handful of new ones, but most of it was existing customers. And really kind of highlights, the ability and our ability as an organisation to, win customers and build long-term relationships which help the kind of business sustain over the medium term. So really pleased with sales performance of the business. We've made really good progress on strengthening our proposition and kind of offering within the market. We've continued to invest into things like data and AI, where we're seeing more and more demand for that within client environments. We've continued to kind of scale our managed services offering. So we've got kind of more and more kind of managed services engagements, and we're seeing more clients move from delivery through to managed services, which is a really kind of important thing we're looking to do moving forwards. We made a number of changes within the services organisation, which I'll talk about a little bit later. And we've continued to kind of push forward on the software side of things, which again, I'll talk a little bit more about. Alongside all of this, obviously, people are at the absolute core of our business. So we've welcomed 86 new colleagues into the business, 50 promotions, done a whole bunch of work on the employee proposition, launched a Save As You Earn scheme, moved into a new London office. So there's a ton of stuff we've done on the people front as well, which has driven improvements in employee satisfaction and reduction in attrition within the business. So overall, FY25 has been a really kind of positive year for the MTEC business. And with that, I will hand over to Neil to talk through the financials.
Thank you, Rory. So this is a summary of the financial results for the year ending 31st of May 2025, the audited results which were announced this morning, and where relevant, you'll see the prior year comparatives again, another 12-month period until the 31st of May 2024. Happy to say that it's been a strong performance across most metrics as summarised on this table. So revenue up 20% to £46.4 million. Gross profit up 13% to £14.8 million. You'll note, though, that the gross profit margin came back by 220 basis points to 32% from 34.2%, and I'll get a little bit more detail on that on a later slide. Sales are up 128% up to £82.1 million against a particularly weak comparative in FY24 of £36 million. And that meant, as Rory said, the contracted backlog is the strongest it has ever been at £92.2 million. So again, 32% increase year on year. Adjusted EBITDA, which is EBITDA excluding impairments, exceptional items and share-based payments, increased by 47% to £3.5 million. and the cash generated from operating activities increased by 294% year on year, with net cash as a result of that increasing to £10.4 million, a 36% increase. And again, I'll give a little bit more flavour around cash flow a little bit later on. The other thing related to that is earnings per share. So basic earnings per share as a result of that increased from a loss of 1.64p last year to positive 0.94p this year. And in terms of adjusted diluted earnings per share, that went from a return of 0.92p per share in FY24, a 40% increase, up to 1.29p in FY25. The next slide gives a little bit more colour around revenue and gross profit. So as in previous years, you'll see there on the left-hand side, we break down our revenue into the 4 key industry groups which we service there. Worth saying that local government, which we have there, includes MHCLG, so the Ministry of Housing, Communities and Local Government, which operationally sits within central government, but for these purposes we split that out because it's a way in which, alongside our software business, we address that local government market. And what you'll see there is that all our industry groups grew year on year, with the exception of public safety and defence, which was flat. But again, they had a good sales period and they entered FY26 with a strong contracted backlog, which we'll see that coming through. But all other industries grew strongly last year. So central government, as a result of that, represents 36% of the overall group. So that's our largest sector, closely followed by public safety and defence at 34% and health at 16%, with local government representing 14%. The graph on the right-hand side exemplifies the strong client retention we've seen since IPO here in the case of FY21, but actually, if we look even further back, we'll see that key clients we've won in each every year we have retained and are still working with them. As Rory said, I think the key story in FY25 is more about deepening relationships with our current clients more rather than new logos, particularly which we required in FY25. But again, that is the ambition for FY26. And then in terms of gross profit, I mentioned earlier that we actually saw the gross profit margin decline year on year. There's really 2 things going on there. In terms of the underlying productivity and utilisation of the people within the business, we saw a further strengthening of that during the period. But as we flagged at the time of our interim results, partly in anticipation of the general election last year, which then came forward somewhat, we did ramp up the number of contractors we had in the business to deal with that risk there. Since then, obviously, the general election came forward, but also because of the strong demand, we're seeing demand go up. So we are in the process of working that contractor figure down. But what it meant was that compared with FY24, when around about 9% of our billable employee or billable base was represented by contractors and partners, in FY25 that had increased to 19%, and it peaked in the low 20% towards the end of last year, FY25. Since when, and we guided at the time of the interims that we thought it would take us FY26 to get that down to a target ratio of close to 10%, so close to where we were in FY24, and that will be a benefit to gross margins in the year ahead. Next slide gives a little bit more detail around that particularly strong sales bookings performance we saw in the year compared with FY24. So you'll see there the 128% increase in the green block in the middle there of the increase in sales bookings over and above FY24, offset against the revenue recognised during the year of £46.4 million. Some key wins there, which we notified during the year, the Department of Education, a £13.2 million contract, which included a managed services component to it, but also DBT, Department for Business and Trade, earlier on, and then the MOJ, and again, a new logo there in terms of the LAA of £8.4 million contract over 3 years, resulting in, as I said, the contracted backlog of £92.2 million. The sales booking figure is, in essence, the value of the sales we make. That can include call-off contracts. So it's not necessarily a guarantee that we ultimately will recognise the full value of all these contracts. And you'll see there's something called lapsed contracts. So that is the value of contracts which we had sold in prior periods, but ultimately we didn't recognise the full value of it before that contract came to an end. So that represents about 5% of the sales bookings we made in the year. Looking ahead to FY26, we started the year very strongly in terms of bid activity. We're very much expecting that this will be H2 weighted. We're seeing a real uptick in activity over the last couple of months or so, and we're taking part in a lot of bids, which we are expecting to see particularly land in the second half of the year. But in the meantime, that contracted backlog figure of £92 million strongly underpins our revenue expectations and profit expectations for FY26. Next slide gives a little bit more colour around the P&L and is in essence the bridge between operating profit and loss in FY24 through to adjusted EBITDA. So starting in reverse order in terms of adjusted EBITDA, you'll see there the advance in margin from 6.2% to 7.5%. There are a number of moving parts to get to operating profit at the top of the screen there. The key one is the impairment which we did in terms of our technology IP in FY24, that charge there of £4.3 million. No impairments this year. The amortization charge on intangible assets therefore relates to our capability IP. There was a £600,000 charge which went through in FY25, and there's 1 year left to run on that. And therefore there'll be another £600,000 charge in FY26, at which point we will not currently hold any intangibles on our balance sheet. As we flagged last year, at the moment we are still continuing to do development on things like software products, but we're putting all of that through the P&L for the time being. We'll give a little bit more colour on that in a moment. Depreciation came down slightly year on year. We are expecting that to increase next year. We're investing more, particularly in our sort of IT-based laptops and things like that, which were coming up for renewal. But also under IFRS 16, we've entered into a few longer leases than previously in our London, Manchester and Bristol hub locations. As a result of that, you'll see under IFRS 16, the change in accounting, which will mean that we have an asset in our balance sheet and depreciation charge on that one. And also there was an increase in the share-based payment charge last year, mainly driven by the LTIP awards made at the beginning of the year, and also the share save scheme, which we launched for all employees during the year, very successfully received, 38% take up, which we're very happy with, and we are looking to do that again in this year, so that all employees can participate in the equity journey and story of the business. Next slide is really very tidy balance sheet, not too much to see here. Tangible fixed assets, again, the main impact there, the main increase is the IFRS 16 lease adjustment I mentioned earlier. Intangible assets, again, that will reduce over the course of the next year to zero. Deferred tax asset, first time we've seen that one, that's related to share-based payments. The options where we're expecting to see some sort of tax relief at some point in time. And just to confirm that last year we used up all our tax losses, so we are now in a position where we're making corporation tax payments and anticipate that will continue into the future. Cash and debtors is very good. Again, all our clients are government related. There is very limited counterparty risk. Most terms are on 30 days and most departments pay us very quickly. So again, very good cash collection, very good cash generation there. And in terms of creditors and payables, again, we like to pride ourselves on that we pay people on time. So that is very tidy, very under control. One of the reasons for the increase in the balance is because of the strong performance last year, we will be paying some bonuses to some staff this year, and therefore there is a provision there which there wasn't in the FY24 comparative. And in terms of cash, all those things ultimately have meant that cash advanced 36% to £10.4 million. Cash generated from operations was up to £3.1 million from £800,000 in FY24. And as I mentioned last year, we did capitalise £1.4 million worth of development costs on the balance sheet. We're not capitalising anything at the minute, and the equivalent charge we put through the P&L this year was about £300,000, and that's based on targeted investment, which is more client-led in terms of the commercialisation phase of our software IP, but that is all going through the P&L. And just to emphasise, the company has no debt, so that £10.4 million gross cash figure is also our net debt figure, and we're looking to make use of that cash balance in the foreseeable future.
Super, thanks Neil. I'm going to run through, kind of provide a bit more context on some of the operational things that have been going on within the business within the last year. Starting on the industry verticals that we target, I'll start with health and life sciences. So, yeah, pretty solid year for the health and life sciences, supported a number of kind of different government programs. I'll talk about one of those, Pharmacy First, shortly. We saw revenue grow there 19%, which was a pretty good performance given the market backdrop. I think slightly kind of challenge more in this area is bookings were not quite as strong as we saw in some of the other industries, and didn't get a place in the digital capability for Health 2 framework, which was very disappointing. Though we flagged that previously at the interims. And obviously there's been a big set of changes announced around the future of NHS England and moving that into Department of Health and Social Care. So there's a lot of changes been going on within this vertical, and I expect there to continue to be changes in this area moving forwards. That being said, we still think there is, real ability to deliver kind of significant impact in healthcare moving forwards. And although the next 12 months might be a little bit more challenging, we think we're still in a really good position to continue growing and developing this part of the business. On the public safety, national security and sort of defence front, yes, as Neil mentioned, revenue was kind of relatively flat in this area year on year. And that was really driven by one particular client, which we knew going into this year wouldn't be doing as much in FY25. So that sort of held back some of the revenue growth in this area. That being said, I think we had a really kind of fantastic year from a sales bookings point of view in public safety and national defence. We won a number of new contracts within the justice system. We got places on a number of kind of small defence frameworks. So overall, this industry is quite nicely set up in FY26 and moving forwards with the kind of the contracted backlog and sort of mix of clients we've got in this space. So excited about kind of what that looks like moving forwards. On the central government front, this remains our sort of largest industry. It grew by 41% last year, which was excellent performance. And as kind of touched on earlier, that was driven by sort of a number of wins, primarily with existing customers, but there were some new customers in there, like the DfE Standards Testing Agency that we announced last year. So really good to see that very, very strong performance in that area. Margins in this area were a little bit more under pressure than in the other two in the industry reference. I think part of that was driven by sort of more of the contractors landing into the central government part of our organisation than some of the other organisations, and that's part of the byproduct of the growth that was driven in this industry. But overall, kind of delivered some really kind of fantastic work within central government over the last year, and in recent weeks there's been a number of pretty high profile launches that we've delivered within central government that we'll be talking about at our interims. Looking forward to updating more on that, because some really good stuff we've been doing there. On the local government and housing front, as Neil sort of touched on, primary focus for this area is the kind of software side of things and kind of going to market with software into this market. Seeing good growth year on year on the software revenue side of things, but from a very, very small base. Pleasing, but still a long way to go. So tons more work for us to do within this area, and I'll talk a little bit more about that shortly. Just wanted to touch on clients and client base. We continue to have an excellent reputation across the UK public sector, continues to be trusted by departments at the very, very heart of government. We continue to have 6 of the top 10 spending government bodies as clients, which is great. And the revenue from these continues to be pretty sticky, pretty high quality, and gives us very long-term visibility. So we're very fortunate to be working with these customers and continue to grow these customers. As we touched on earlier, kind of contracted backlog, growing to 92.2 million. That gives us, a really good foundation to continue kind of building on and continue growing on within the core customers that we work with. That base enables us to expand and do more within those customers as well. So that gives us a really good foundation. On the delivery side of things, we're quite nicely diversified. So, across FY25, I think we've delivered about 150 work streams across customers. So that's across central, health, defence, justice, local government, all of these areas. So what's quite nice about that is we're not overly dependent on one particular area. We've got a real spread across work streams, across clients, across industries, covering lots of different things. Also seeing, continue to see very, very strong client retention. Once we engage with a customer, we tend to build sort of long-standing relationships that provide stability and repeat business. And we see that coming through in things like our client satisfaction scores. These remain very, very good and reflect, the high quality reputation we have for good quality delivery and reliability of services we provide. So, overall client base remains very, very strong. I thought I'd just talk through a couple of things we've been working on in FY25. So first one I thought I'd touch on is Pharmacy First. So this is an NHS England initiative that launched in January 2024. And really this is about driving more patients to pharmacies for first-line minor health conditions rather than putting the burden on GPs. So we've been doing a whole bunch of work with NHS England on this programme, enabling sort of data sharing between some of the core GP systems and pharmacies to prevent pharmacies having to use faxes and phone calls as much, right? So to enable much more efficient sharing of that. So we've been working very closely with the NHS Direct Care team and working with, a number of the kind of suppliers who provide GP systems and kind of parts of the kind of central NHS organisations to roll out from a technology that enables pharmacy first to operate. Huge impact. More than 4 million patients have accessed pharmacy first services since it launched, and only 8% have been referred back to GPs. So, really having a very, very significant impact in trying to kind of reduce the burden of GPs. So, good example of the type of thing we're involved in within NHS England, within some of our clients. Thought I'd provide another example. So, this is some work we've been doing with the Home Office. So, we've been working with Home Office for the last 4 years as part of what's called their enablers portfolio. And really that enablers portfolio is responsible for making it easier for every part of the Home Office to deliver digital technology. So within this delivery, we've been doing a whole bunch of different work across different parts of the Home Office, trying to kind of really streamline how and remove duplication around the way kind of Home Office are delivering different parts of the technology. So things like, improving kind of CRM systems, improving central kind of intelligence and kind of making that more joined up across the different parts of the Home Office. So some really, really fantastic results, user satisfaction increasing from 26 to 70%. We've saved significant amount of money in duplicate costs and reducing costs in different areas of the Home Office. So, a good example of something that we're doing in a big government department to help them drive efficiency and improve kind of how they're providing services at a time when we public services are under a bit of financial pressure. So that's a good example of one of the things we're doing in the Home Office. We jump onto this next slide. So I want to talk a little bit on some of the work we're doing on the services side of things, and really there's sort of two key things I want to call out here. Firstly is around, continuing to build our end-to-end offering. And the second bit was around, how we're kind of working to try and improve the quality and the stickiness of the revenue that we deliver. So on the end-to-end offering front, clients continue to look for partners who can support them on their end-to-end transformation journey. And this is kind of one of the key things we've been talking about for a few years, but continues to be very, very true. As we look to scale and kind of win larger and larger contracts, it's really important that we've got the breadth of capabilities to be able to support those clients on that full end-to-end journey. So, right from sort of early stage sort of advisory through to delivery and then kind of running services. So we've done a bunch of work on this over the last year. We've made a kind of number of changes around things like our cloud practices, our architecture practices, some work on the cyber side of things. We've doubled down on some of the partnerships. AWS, you might have heard us talk about before. We're doing some work with Databricks, which is a big sort of data AI type partnership. We've done a lot of work around kind of AI-enabled software engineering. So, we're really investing in making sure that, the services we provide enable our customers to kind of really go from, early stage sort of advisory right through to run. One of the standout areas in the last 12 months really has been the sort of data and AI front. That practice has continued to grow really, really nicely. And I think what we're seeing across the board is more and more demand for support with data and AI initiatives. So everywhere from Department for Education, Ministry of Justice, Department for Health and Social Care, the work we're doing in housing, all of these are looking for, support with the data and AI side of things. So really, really important part of our business, and we expect it to continue to be a really important part of our business moving forwards. And some of the work we've been doing in partnership with Databricks has also been really powerful there. So, we're doing more and more with them in different parts of the public sector and expect to do more and more with them moving forwards too. On the strategy and design side of things, we continue to kind of build out and kind of scale our offering in this space. Really this is about making sure we're embedded earlier in decisions and kind of helping our customers to kind of shape the programs of change and kind of helping to shape those things. And we've been making some really good progress on that. So continue to see that move forward nicely as well. And the other bit I want to touch on was policy of earnings and the sort of stickiness of revenue. And really we've been kind of spending quite a lot of time building and scaling our managed services offering over FY25. And really that's about making sure that as we deliver things for clients, we continue to be engaged long-term to provide the run of those services. And, I think we've highlighted the DfE contract last year, and that's a good example of the sort of thing we want to be doing more and more of. Because it gives us good kind of predictability and kind of forward visibility. So overall, services absolutely core and foundation of our business, and continuing to evolve this and kind of move it forward to kind of enable us to win larger and larger contracts and kind of scale the offerings we're bringing to customers. Jump on to the next slide. Just wanted to kind of touch on the software front. So, software remains a really important part of our long-term strategy. We continue to see it complementing what we do in services. and providing sort of recurring, scalable revenue streams. That being said, it's not moved forward as fast as we would have liked. It's taken us longer to kind of scale the go-to-market and get customer adoption than we anticipated. That being said, we have seen some good progress in the last year. I think revenue is probably up 100% in the last year within this area, but it's from a very, very small base. So we want to continue to see that sort of trajectory and continue to see that growing moving forwards. One of the things we would say is that a lot of what we're seeing from a growth and a progression in this space is from expansion of customers rather than net new. So what we're finding is once we've got a software product in place within a particular organization, our ability to kind of sell additional modules and upsell and scale from there is very, very significant. So for us, the key thing we look at moving forwards is how can we scale the customer base in this space as quickly as possible? And we think kind of M&A may be an interesting way to help us achieve that and really kind of broaden that customer base moving forwards. So overall software, continues to be an important part of our long-term strategy. Definitely more work to do in this space, but we can remain very excited about it as an opportunity, and kind of we think it's an important part of the future of the organisation. We jump on to the next slide. I thought touch briefly on social value. Social value is pretty central to how government procures services. So it's really kind of not a side note for us as a business. It's really embedded very deeply into kind of how we operate as an organisation and really kind of how we've operated for a number of years now. Some of you may be familiar that the government's released a new social value model, and really kind of what they've announced with that is effectively 10% of the weighting on public sector tenders is allocated to social value. So, it has a very direct impact on the ability to win contracts. It's not an optional thing to invest into. We need to be doing that to be able to win and succeed within this market. And there's tons and tons of different things we're doing in this space. We've been doing a whole bunch of stuff around sort of being carbon neutral, embedding more green ways of working, hybrid models, lots of things in that space, lots of things on the workforce space. So, diversity within the team kind of trends above sort of the tech average in the UK. Lots of focus on well-being, flexible working, things like apprenticeships. We're an apprenticeship provider. Things like that are a really important part of being an organisation that delivers kind of strong amounts of kind of social value to customers. There's lots of other things we do in this space. I'm not putting them all on the slide here because I think it would take too long to go through, but it's absolutely critical for us to be able to provide kind of social value to our customers, because it's what enables us to win and kind of compete on some of these contracts, because 10% of the market is allocated to social value. So we'll continue to be a really important part of how we operate moving forwards, because it will ultimately drive growth in the business. So on the people front, total headcount is increased to 435. It's up 14%. A good proportion of this has been the contractor increase. We saw that in H1 and continue to see that through to H2. As Neil touched on, we're working kind of hard to bring that number down, because we really think that's important from a margin point of view. That's where it was at the end of FY25. Really pleased to see attrition is down to 15%. We've seen much, much stronger engagement levels within the organisation. We've been doing a lot of work internally on this and continue to see employee satisfaction scores improve, which is really good. We did a lot of work around internal structuring, sort of management development, introduced new careers frameworks, expanded our apprenticeship program. So lots of things to kind of help drive an environment which enables our people to succeed and build sort of longer term careers in MTEC. So did a lot of work on that over the last year, and I think a lot of that's been very successful. Neil touched on earlier, but the Save As You Earn scheme, 38% take up of that was really fantastic to see. It's really great to have more and more of our colleagues who are sharing in the long-term success of the business. So as kind of touched on earlier, looking to do that again in FY26, because it's really important to make sure we're all aligned and growing in the same direction. Alongside that, we also moved into a new London office. Really that's been kind of selected to give us good amount of kind of flexibility moving forward, so a good amount of sort of burst capacity, similar model to what we're doing in sort of Manchester and Bristol. That's been really great to have a new location. And then overall, continue to invest really kind of strongly in our people. That investment is paying off by stronger retention, delivering fantastic outcomes for our clients, and really building a culture that will sustain and continue to deliver the growth that we want to achieve over the coming years. So that's all I wanted to kind of cover on the operational side of things. In terms of outlook, I think we entered FY26 in a strong position. I think that was clear from the contracted backlog and the sales bookings we achieved last year. Trading has started, in line with management expectations for the year, right? So we're pleased to see that, and revenue is underpinned by the 92.2 million in contracted backlog we carried into the year. So it really gives us very strong visibility and a fantastic foundation to continue driving the growth on. The conclusion of government spending review, in June, July time, that now theoretically gives our clients good visibility through to 28, 29 on funding and kind of where they can invest. And we've really started to see that feed through into high levels of procurement activity as we move through the summer and people got back from summer holidays. So there's a lot of activity going on the procurement front at this point in time. Good increase there. So that's really good to see. Continuing to see the government, talk very clearly about the key role technology is going to play in delivering its priorities, driving efficiency, outcomes in health, justice, education, all of these things are really key priorities for government, and technology plays a really, really key role in delivering those things. And you'll have seen over the last year, numerous mentions of the role technology providing government strategy documents around defence and industry strategy and all sorts of different areas. So overall, there's a really, really kind of solid basis and thesis for continuing to see the business succeed. We remain really well capitalised, debt-free, cash positive. Net cash position at the end of the year was good and obviously clearly advanced since then. So we're in a very strong position to look at kind of investing into capability and selective M&A opportunities as we identify them. So overall, super confident about about FY26. We continue to expect to grow, drive profitability and free cash generation again. We will continue investing into the areas that will drive the business over the long term, and really looking to deliver strong returns to shareholders. I think I'll hand across for Q&A.
We have got a couple of hands up already. The first hand was Robert Plant. Robert, please go ahead.
Thank you. Morning, Rory and Neil. The statement mentions potentially using debt financing for inorganic growth opportunities. You had over 10 million of net cash. Does that mean there's more than potentially 10 million to spend on M&A in the next year?
Yeah, I think that's a fair assumption, Rob. Obviously we are actively looking at M&A opportunities. In terms of working capital purposes, I would estimate we'd probably want somewhere between 4 and 5 million pounds cash in the bank. So that means that we do obviously have a substantial pot and a growing pot of cash that we could deploy to do M&A. We would, depending on the nature of the acquisition that we were looking at doing, consider using debt as part of that. I think we'd be relatively cautious on that in terms of the leverage we would look to apply. But I think also it's fair to say that over the course of the last sort of year and a half, 2 years, the advance we've seen in the share prices, I don't think would be necessarily backward in coming forward in order to deploy our equity. So I think in terms of our ambition and where we think we could go on that, we feel that we have a number of options ahead of us, of which cash and debt is part, absolutely.
The next question comes from Kai Korschelt of Canaccord. Kai, please go ahead.
Yeah, good morning, gents. Familiar background there. Good. Well done on the results. I had a couple of questions just around visibility and particularly the backlog distribution. So it's a multi-year backlog. I'm just wondering kind of how much of it, if you have any indication, is sort of deliverable over the next 12 months versus multi-year. That was the first one. And then the second one was just around the planned push into other or new larger departments like HMRC or MOD. You've done really well with existing accounts at the moment. Kind of what is the strategy, or how would you approach potentially breaking into those departments? Thank you.
Yeah, so Kai, in terms of the contracted backlog figure, so this was the total contracted sales. We're very happy with the position we finished at the end of last year. That there are a number of things included in that. So again, we operate across a number of different clients. So that's made up of a large number of different contracts. They can all vary in nature. So some of those might be individual statements of work or contracts. Maybe call-off contracts of only a year in length. Some of them could be much longer, so 3-4 years time. So on average, I would say that we would look to recognise that revenue that is in the contracted backlog there will be, on average, probably a 2-year time frame over which we'd expect to recognise that, with some sort of creeping into year 3. The cadence of that, when we recognise it, would tend to be more front-end loaded than back-end loaded. But what we find is, particularly as we go for larger contracts, we've had a few very nice awards of approaching £20 million over the last year or so. Those tend to be contracts which we recognise over a longer period of time rather than a shorter period of time. So it's very difficult to very quickly be able to say, oh yes, well that level of contracted backlog means that there's definitively going to be that level of revenue which we can recognise over these periods based on that. As we highlighted, there's always a possibility, because these are time and material contracts, and we don't necessarily always see everything awarded under that, whether that ultimately will always come to fruition. But I think what we can say is, of that £92.2 million, that is particularly strong, and therefore, the wording we say is, we think it strongly underpins our revenue expectation for FY26. I think we feel very, very comfortable with that, with the anticipation, but also that will then take us very, very nicely and contribute very nicely to FY27 and beyond.
And on the second point, Kai, around some of the new areas we're focusing on. So, we've been making some investments into new sales leadership to kind of help expand out into some of these areas. So we brought in somebody specifically to lead on the defence side of things. We brought somebody into the organisation who has very significant experience in the Home Office. So we're making sort of very sort of targeted, focused hires to help expand out. That alongside, we also have very strong profile and network across government. So we're using a combination of different things to really kind of try and drive into those accounts that we're not kind of currently active in. Sometimes we'll need to make decisions to be slightly more price competitive going in there to sort of open up new accounts. So we will make those decisions as and when we think it makes sense for the organisation, sort of longer term sort of value creation. So we may decide to kind of make decisions like that moving forwards.
Great. And could I just have a quick follow up then? And I guess in terms of sort of sales cycles for a provider like yourselves who doesn't have a track record in one of these accounts, I mean, what would the sales cycle typically be? Or I guess, would you expect to get deals in the current financial year, or is it slightly more longer term than that?
Yeah, I'd be disappointed if we don't win some new clients in some new areas in this financial year. I think the sales cycle on some of those new areas is not. Certain parts of it, I think, is longer. So something like defence, where that is a very, very new area for us. I see that being a slightly longer horizon. Other areas like expansion in Home Office or HMRC or DWP as an example. These are areas where there's a lot of crossover with what we're doing in other parts of government already. So the cycle on those shouldn't be as long. So I'd say most of those central government type departments we want to break into, they should be slightly shorter. Things like defence, slightly longer would be my expectation. The other thing to touch on related to that is where we do see a slightly longer sales cycle, like in the defence space, we may decide to subcontract into partners who've got very established positions in those markets. So we have got conversations going on with, you can probably imagine some of the organisations we're talking to there who have established positions and don't necessarily have the digital technology capability that we do.
The next question is from George O'Connor at Progressive. George, please go ahead.
Good morning, guys. Really nice to see the KPI evolution in this print. 3 quickies from me, if you wouldn't mind. Firstly, great to see the new career grading system, but given where gross profit has headed, are these contractors offering unique skills, or is it simply a bodies count that you're looking for? And then secondly, I appreciate that you are the delivery team, but can you give us any clarity in terms of how transform and run are stacking up at the moment? And then finally, given that the UK Gov is now more sure-footed, any change from the new regime in terms of maybe outcomes-based pricing, pressure on underlying day rates? Are you seeing sort of AI natives start to sniff into your accounts? Many thanks.
Thanks, George. Right, we're going to go back over what they
career grading and contractors.
Career grading and contractors. Yes. So career grading, that's really a sort of an internal thing to give us more flexibility about how people progress within our organisation, but also how they get deployed into client organisations. So you know that's really about that kind of flexibility for us moving forwards in terms of getting the right shape of people deployed into the right client organisation. So that's been an important thing to do, and we expected a bit more work on that in FY 2026. On the contractors front, you know, our target state there is really to use contractors where they provide specialist skills. But I think it's fair to say the numbers we've seen in FY 25, they're inflated because, you know, we needed to bring headcount in. So there's a whole bunch of the contractors that we had in the business in FY 25 and to some degree kind of the early parts of FY 26 as well, where that's more about headcount numbers rather than specialist skills. And what we kind of try and do, and we try and actively manage, is, you know, replacing those with employees where we can, and we're on a kind of quite an aggressive hiring push at this point in time to make sure that we can kind of transition more and more of those more easily replaceable contractors with employees. You know, I think long term we'd expect that sort of 10% of sort of more specialist contractors to be about kind of where we should be on the contractor front. So was that second one was
managed services, you know, so, yeah, the other side of the business.
The other side of the business. Yeah, so we have continued to, so we've invested into both sort of the advisory sort of design sort of strategy kind of space. It's a relatively kind of small area for us, but it is strategically really important because it gets us involved in conversations much earlier, and can then therefore we can kind of shape and get a kind of better sort of sense on kind of what's coming down the track and kind of make sure we're well positioned for that. So yeah, we've made a number of hires in that space. You know, we continue to make some nice progress on it. We haven't kind of separated out, you know, in terms of kind of revenue contribution from that area at this point in time. You know, I think over time we may decide to do that, but right now we don't do that. And on the managed service side, yeah, again we've made a number of hires into this space. We brought a kind of new managed service leader into the organisation to lead on sort of the next phase of what that looks like. Somebody who's come from, you know, probably an organisation some of you will be familiar with that was acquired last year by a big IT firm. So we're continuing to kind of hire the right people into the organisation to help kind of scale up these things. Yeah, over time I'd like to see sort of a really nicely balanced services business that, you know, the bulk of what we will do will be delivery, but I'd like to see that managed service component kind of becoming an increasingly larger component of our organisation, and also the sort of the advisory, the early stage stuff that I probably don't see that becoming quite as large as sort of delivery or managed services.
And government procurement, obviously changes in trends, AI.
Yeah. I think yeah, great question on this. So we're doing a lot of work around you know, AI enabled delivery, and sort of how we can really accelerate kind of delivery using kind of AI enablement. There's some fantastic things we're really doing on that front, so we're really excited about it. We're sort of trying to proactively have conversations with customers about how we can shift more and more towards outcome-based opportunities. You know, we're not seeing a push at this point in time from government on that, but we think it would be beneficial for us if we did see that. So we're kind of talking to customers, particularly kind of friendly customers, about how we do more and more of that moving forwards. On sort of the pricing front, I think it's fair to say, yeah, it is a competitive environment. We have definitely seen pricing pressure in a few places. We have, you know, been unsuccessful on some things because of pricing, and that's okay. You know, we want to make sure we are pricing things that are right for our organisation. So if we can't win things on those pricing, then it's probably not the right business for us. But it's definitely a competitive environment from that point of view.
The next question is from Paul Richards of Dowgate Capital. Paul, please go ahead.
you very much. Morning, gentlemen. Great set of results. Neil, very much the type of numbers I'm used to seeing from your time at LTG. So great to see that at MTEC as well. Really encouraged to hear that pick up in procurement activity post the summer break. Just wondered on the shape of that. My understanding was that last year there was a number of small to medium-sized contracts that were available, but the larger ones, the multi-year ones, tended to get sort of caught in government procurement. Obviously, you've had a couple of decent-sized wins, multi-year contracts. But is it those ones that are now freeing up? Is it still lots and lots of small pieces of work, or is it sort of the medium and now the larger ones? Now you've got certainty of the spending review out to 28, 29. Those are now coming up in the way that we hope they would.
Yeah, good question. So we've seen a real mix, right? So we've seen some very large contracts come out, some medium-sized ones that we think are addressable by us, and some sort of small mid-sized ones that sort of be more sort of bread and butter for us. So we're seeing a real mix across most areas of government at this point in time in terms of kind of stuff that's coming out to market. So the really big, the really large ones we're seeing in some of the some of the sort of larger departments like the Home Office. We're seeing some very major contracts come out there, and then in other places like education and in lots of other areas we're seeing decent sized contracts, tens of millions, 20s of millions come out to market there across a number of different areas. So I think overall I think it's a much healthier environment than it probably was 6 to 9 months ago. But there's work to do, right? It's also a competitive environment, so we've got work to do to continue kind of pushing forward and winning some of these things.
Just hand back to Rory. Any closing remarks?
Just a big thank you to all of you for joining today. Great to have you with us, and really look forward to seeing you all again in 6 months' time and updated on the progress we've made in the first half of FY26. Thank you all. Have a good day.